Hello, and welcome to This Week in FRAX. I'm your host, Sam McCullough, and I'm joined by DeFi Dave and Capital K. Well, guys, it's been a tumultuous week. Actually, the vibes are good. Actually, we just came off of an interview with FRAX, and the vibes are spectacular, I think. We survived one of the top, actually, when I think about like all the nasty, bad things that I've gone through in crypto over the past few years, this is probably top 5. And taking it from Westwood, who made a nice point in chat, there's Mt. Gox, Black Thursday, March 2020, Terra Luda, and now this USDC bank run.
All within a year. Terra Luna and this.
I know.
So, and FTX.
Exactly. So if we can survive this, if the FRAX protocol can survive this, we should be able to survive anything.
Yeah, I say it's like a rubber band. Like, we're going, all this energy that's like being pulled back, whether it's like the depegging, FTX failing, whatever else is going to happen between now and whatever. Eventually that band's can get released, and there's going to be a lot of positives.
Yeah. So for those who haven't been opening up the news and reading Telegram all day, we'll just run through a quick summary of what happened over leading up to last Friday. So there are a couple big major banks that have been supporting crypto firms. That would be Silvergate, Signature, and Silicon Valley Bank. Over the past year, all 3 banks have faced hardships due to rising interest rates. So if you don't know how the bank works, you give them your deposits, and then they go and they lend out your money. They use your money as collateral to go then buy like treasuries or something. Usually this is pretty standard, right? Like as long as you have a good mix of depositors who come in and give you their cash, typically not everybody needs to run for the exit at the same time. But those 3 banks, Silvergate, Signature, and Silicon Valley, all catered to highly specific sectors of the economy. Silvergate was a almost 100% crypto bank. Signature probably did about 20% of its total deposit base came from crypto, and Silicon Valley Bank was providing loans for crypto companies as well as early stage tech companies and the life sciences companies. So Silicon Valley Bank is the notable one because they were, I think, the 16th largest bank in the United
20th.
States. 20th or 19th, somewhere around there, right? So top 20 bank inside the United States. Really, they were a bank for more than 50% of all startups coming out of Silicon Valley, and also just banked a lot of people. They weren't just a bank for tech startups. They also had a huge life sciences biotech division that is based all over the United States and really would fund these companies. Like if you had a winery or if you had a tech company, they'd be the only ones who would come in and give you banking services and then provide you like an immediate loan against your Series A. So if you raise like 10, 20 million in a Series A, they give you an immediate loan against your equity for like 2 to 3 million. And founders love this, right? This is why so many people flocked. Like I've heard interviews from other people that said like, if you were like a wealthy founder or a high powered founder of one of these bigger startups, they would just cater to you. They'd have like a team of just people who would like roll out the red carpet for you. They'd show up your house. Jason Calacanis said that like, they'd show up, they do a mortgage in like 10 seconds and they would just make things happen that like other banks. Like I saw a guy on complaining on Twitter. He said like, okay, Silicon Valley Bank is dead. I went to my Wells Fargo and I'm a VIP there. They said they had like $100,000 max limit on withdrawals that had to be approved by like 3 people, right? And it was going to take like a day. They also didn't have like a customer hotline that he could call to do this wire, and just a bunch of other stuff, like normal shit at banks. And so the Silicon Valley people really catered to like a specific clientele of making their lives as easy as possible when it came to just moving money around. And so all of this money during like zero interest rate mania had just been flooding into this banks. And especially in 2020 and 2021, you had trillions of dollars that were created. And then this just floods into banks. People have all this new money and it's got to go somewhere. So they just deposit it into the banks. The banks are like, oh, wow, this is great.
Money.
We have all this money, right? Like, what are we going to do with it? So in their traditional banking minds, they were like, okay, this is going to be sticky deposits. Let me go and I'm going to take it and I'm going to buy some like 10-year muni tax deferred bonds. I'm going to buy some like 10-year treasuries, maybe some 30-year mortgages and stuff. And like, if you're a banker, like a traditional banker, this just makes sense because your deposit base is sticky and you kind of know that like it's just going to go up and down, but over the average, it's just going to go up. And in the next 30 years, you'll get that bond back. So like buying a 10-year muni bond at a point and a half, so like 1.5%, just made sense at the time, right? And they didn't hedge any of that risk. So when bond prices went down, right? So when yields go up, bond prices go down. They got screwed because their entire portfolio at all three of these, or not Signature. We'll leave Signature out for now, but specifically Silvergate and then also Silicon Valley Gate have like, it's just bonds, and they're all long. The duration mismatch is not there. Sorry, they have duration mismatch, meaning that like they have all these short-term depositors, but all of their bonds are for 10 years. So they're making 10-year bets while their depositors are making like 2-year bets. And so they're completely off. And with the rise in rates, they just got screwed. And so Silvergate was the first casualty, not because of this, well, somewhat because of this bond risk, but mostly because depositors getting screwed in post-Luna collapse.
Why did they all start with S?
Yeah, I know. Everything.
Silvergate, Signature, Silicon. It's SI. All of them are SI something.
Yeah.
But like, I think the thing is, like, what's interesting is Silvergate wind down deposits in an orderly manner. Didn't lose any money. Silicon Valley, that's where things got bumpy, and that's where the trouble began, quote unquote. And that's, you know, the FDIC. I mean, first the California regulator swooped in, and then the FDIC swooped in. And what that has to do with crypto is, you know, USDC. I mean, Circle, the parent company, they were banking at using Silvergate. They had $3.3 billion at Silicon Valley Bank. And, you know, the market, for the first time, USDC was no longer the risk-free asset, and it depegged. And because of that, like, FRAX depegged. Actually, I saw a comment on like our FRAX Check YouTube, and it was like, yeah, that had to be the funniest comment. Like, it's not. It's like, oh, FRAX didn't. I said like FRAX didn't depeg, the dollar depegged, or something stupid. I'm just like, wow, I just sound like such an idiot there. But like, yeah, FRAX depegged because of its the reliance on the USDC. Like, USDC is the reference peg, not just for FRAX, but all of DeFi. I think that's the thing I wanted to like point out.
Yeah,
it's like all of DeFi. Yeah, go ahead.
Leading into Friday, like there was all this news about Silicon Valley Bank. Peter Thiel told all of his investors to get out. And then Thursday night came. There's a lot of like tension around it. Friday morning, the FDIC announced that they were putting the bank into receivership, which just means nationalizing the bank. And then at that point, they would find a buyer for it eventually, which they did over the weekend. And Silicon Valley Bank is already up and operating again after they guaranteed the assets. So Friday, everything just goes to hell, right? People are scrambling, trying to figure out who's got money, where. And one of the 7 banks that Circle uses, one of them was Silvergate, which they had moved their money out of. But they came out and they announced that they had exposure to USDC. And there was it was about a 24-hour period where Circle didn't say anything, probably because legal reasons and also trying to figure out their exposure. And everybody was just freaking out. Friday, people were just trying to get out of USDC as much as possible. The 3 pool got drained down to like $12,000 worth of USDT left. Everybody was just running for like Bitcoin, for ETH, for USDT, just trying to get rid of all their USDC as possible, which didn't really make sense to me, right? Like when you looked at the whole and you looked at who was going to cover it, it just made sense that they were going to be able to cover the whole thing, either from Circle's revenues or from Coinbase.
I mean, they guaranteed deposit. I mean, they guaranteed backing with their own corporate like revenues and stuff.
But they don't have 3.3 billion cash though.
No, but it wasn't going to be 3.3 billion cash. They would have gotten probably like 1.5 of it immediately, and like if they had been shut down that way, 1.5 immediately, and then they would have had like another like 1.8 that they would have had to cover. And Coinbase and maybe some other creditors or something else would have plugged the hole anyways. I don't think there ever would have been a hole, but people like freaked out. They started immediately selling, and most of the selling was on centralized exchanges. It wasn't really in DeFi, right? Like the DeFi stuff, DeFi kind of like functioned pretty well for most of the time. Like nothing in FRAX broke on that Friday, right?
I mean, Curve ran
like,
out
look,
of
other
USDT just like it planned to. I mean,
Yes,
everything
of course,
worked as designed. Like,
Yeah,
it
everything
just
worked as designed.
designed so well that
Yeah.
there was just no stopping it. You know,
Yeah.
that was pretty much what happened.
So everything worked great. There wasn't really like in DeFi, there wasn't too many issues. I know there was an issue with DAI and their PSM where like when as soon as the USDC went under, you could like mint all of this DAI at like a better rate or something. And so like Justin Sun came in and minted like 1 billion. There was a couple of like things that was happening on the FRAX side. I went back and checked the Telegram today. So Michael from Curve, who is one of the largest Fraxlin borrowers, also has a huge Curve position on Aave. And so what he was doing when Frax was 88 cents, 90 cents, was that he was borrowing as much as he could within reason from as USDT from Aave, and then taking it, buying back USDC and Frax, and then paying down his Fraxlin debt, and then repeating the process over and over and over again as people were giving all this free money for him to kind of pay his debts down.
Good trade by him.
Yeah,
great trade.
It worked.
Great trade.
I wanted to bring this up, and if the Fed, I mean, well, first thing, let me say, I was actually quite surprised, and now it makes me very bullish on how fast the government can actually act, right? It was one weekend, and then the next Monday, you could withdraw, like just straight up like banking hours.
I mean, that's
if
like
it
the
was just turned on.
FDIC. FDIC is a private corporation.
Yeah.
Yeah, there's
a great documentary that 60 Minutes did probably like 25 years ago about the FDIC, which is like, I watched it like last year at some point or something. I just randomly turned on YouTube and it popped up, but it's everything that is there is still relevant today about the FDIC. Like they're really good about shutting down banks. Essentially, they they try to shoot for Fridays, so they have the whole weekend to like work through these things if they can. But essentially, they just come in, they shut everything down, they don't give anybody access to do anything, and they just work through all the accounts over the weekend to figure out like how much money there is, how big of a gap there is, and how much money they can. They immediately give all the money back to insured deposits, right? So if you're under the 250,000 cap or even over it, you get all that money back immediately. People that are over it, they then have to take a bit more time. If they have the whole weekend, like in this case, they're able to say like, okay, we can give 50% of it back now, and then like it's going to take 6 to 12 months to do the rest of it. Which would have happened in this case had there not been the bailout from the FDIC and the government. So there's a lot of fears in the broader economy now about like what other banks are.
Wait, you want to know what my favorite reframe from the week was?
What's that?
I'm not sure if you saw this, but Circle came out with a statement saying, because like people are like, oh, crypto could be a systemic risk to the banking system. Circle was like, no, it's the other way around. It's the banking system that's a systemic risk to stablecoins. And he's right. Like we saw it actually play out. Like the fact if Curve actually had, let's say there was an actual proper stablecoin issuing framework in place, and stablecoin had that USDC had that license, and they could just put it in like a normal bank account, or if Custodia could have gotten that Fed master account or anything, this wouldn't have been a problem. There wouldn't have been a reliance on so many intermediaries. But because there's so many different intermediaries and custodians, we had this problem. And Circle's definitely right in that reframing.
Right. And I think one of the biggest things. Yeah, go ahead, Kiet.
Hold on a second. Just the second part of my question was, if the Fed did not step in, would have USDC repegged as quickly as it did?
Oh, yeah. Yeah, definitely. Coinbase and Circle would have made a joint announcement saying like, we're filling the
guaranteeing
all deposits. Like their entire business model depends on it, and like there's no way that they would have let a hold happen. And that's why the 88 cents made no sense to me.
So I looked into that, and Coinbase actually has about 4.4 billion in cash since last 10Q of last year. So they could theoretically plug the whole hole. And my thesis on that was like, Circle would USDC is pretty much synonymous with Circle. People who synonymous with Coinbase. People who are on Coinbase probably doesn't even know Circle exists. They probably believe that USDC was issued by Coinbase. Therefore, like if Coinbase were to let this thing go bad, that means their whole brand is just busted. And there's no way, there's no way they would have let that happen.
No
now,
way. Yeah.
would the market react as quickly as it kind of did? I don't know. I don't know if it would have repegged within a matter of like 12 hours after the announcement, right? I don't know, because for a good chunk of the day, even after the Fed said that they would back it 1-for-1, USDC was trading at 98 cents for like 12 hours. And I was just like, wow, this is a free 2% for anybody who wants to like lever it here and get even more. But I was like, it was very surprising to see how people were so untrustworthy that they still didn't fully get in there.
Markets are
after the
irrational.
first conversions. Yeah, until the first conversions went through. Then they're like, okay, the redemption does work. Let's bring it back.
Yeah. And, some of the winners on the weekend were the actual, like, fully decentralized stablecoins, like LUSD, like, did very well.
Crushed
over the weekend. Crushed it.
Yeah. And LUSDW, we got to recognize that.
Yeah. So congrats to them for building a very good system over there.
I mean, it's just Psy, right? But there's beauty in simplicity.
Exactly. Yeah. And, it just shows that we at FRAX have a lot more work to do on the policy side.
Yeah.
And speaking of policy, I think there's a lot of double taking happen now because, Dave, you've talked about the Stable Act and what it would mean for stable coins and the growth of stable coins in the broader economy. And I think there was a general negativity towards it when it was first announced. As if it was
people are stupid.
Yeah.
People are so fucking dumb. It pisses me off because they just see like anything with legislation as bad. Like, oh, the government's trying to like put rules on. It's like, read the act. Read what's actually in the text. If you read the Trust Act, it just provides a framework for payment stablecoins specifically, like USDC and Tether, to exist. It would provide them with like access to banks and access to services like any other business would have. And we would not, like I said earlier in this program, like this situation would not have happened in the same way because there's such a reliance on custodians. Like once this Stablecoin Trust Act gets passed and stablecoins can get apply for Fed master accounts, then it's just game over.
And I think it's probably going to come sooner than later now.
Yeah.
Especially since the legislation's already been proposed, it probably will gather widespread support at this point because if you look at Circle's model, right, it's not bank money at this point. It's money that's supported by banks. And obviously that means that there's custody risk, which was highlighted over the weekend. The Stable Act would essentially bring USDC in to be bank money. And that's what you want, because then you don't have to rely on these like custodians.
There's less risk. It's actually, it's like all of DeFi is built on top of this risk. And like we saw what happens if, there's uncertainty, a lot of it depegs. So, this is like these acts is for stable coins. This is something that we want. It's just like, if we're in a dollar world, like we want to be in the dollar system.
Yeah. I think if it doesn't pass, right? I mean, the alternative would be for a bank like Custodia for Circle to move there and have its and bank through there, right? If it's still forced to be this third party thing, but Custodia hasn't gone through.
If it doesn't pass, I think the Tether model takes over.
Potentially,
the Tether model is like this, like just offshore dollars, I guess.
Opaque.
Yes. I guess.
Yeah. And so I think we are at a really critical junction in a policy perspective where, we really need to rally the troops to make sure that nothing like really nasty gets passed, because, there's going to be a lot of people out for blood at this point and who are going to be dancing on the graves of SBF and the USDC bag and everything else and Luna as well too, that are just going to try to push like bad legislation through.
I think like the biggest issue is if no legislation gets passed this session because of FTX, because FTX donated to so many politicians, no one wants to put like their career on the line to like fight for crypto, except for like a few brave individuals. Because like So that's like the only thing really stopping legislation passing. Maybe it changes because of this whole USDC depegging, and like something needs to be done. I think like action will come from the House first. There's no doubt in my mind it will come from the House Financial Services Committee, specifically the subcommittee on digital assets. You know, French Hill, pro crypto, he's the chair there. Patrick McHenry from South Carolina, he's the chair of the Financial Services Committee there, and also Tom Emmer's on that committee. That's where you're going to see the action happen. And so Republicans have the House there. The biggest issue will come with Sherrod Brown of Ohio, who's the chair of the Banking Committee in the Senate, and he's anti-crypto. I wouldn't call him as bad as Elizabeth Warren. I think he's just when hearing him talk, like I understand his concern and his criticisms. He's just like, what's crypto actually used for? Like someone from this is like a bad image problem crypto has. It's people outside of it sees, the velocity of money so fast that it seems like a giant casino. And at times it definitely is. But there, more and more people are being brought online in this world on chain. And it's up to us in crypto to show the actual utility of it. And that's not as sexy as, like this hot new coin is like under like 5 million. Like, like look at this airdrop happening like this and that. Like, yeah, it's not sexy, but this is like, if you want to like gain like mainstream acceptance and for it to go up to, more adoption, like you have to do a better job of highlighting the utility stories. And you actually saw that with Circle today, with Jeremy Allaire's Twitter. I think either today or yesterday, he was like, like look at USDC, like helping refugees and the war in Ukraine, like like highlighting the utility more, which isn't sexy, but it's necessary. Does that make sense?
Yeah. Well, I think there's going to be a lot of political change that comes out of this, and stablecoins is probably going to be one of like the lesser changes that happens, because now we're going to have a national conversation about deposit insurance. I think we're going to start potentially treating banks as these like hedge funds almost, right? Speculative investment funds, right?
Yeah, that's it. I hope not. That's like, you shouldn't, like, the reason why our banking system works is because we don't have to think about that. We can just like deposit. It's like, it'll be okay. But like now it's like how's my well, I guess everything is insured.
There's a strange like dichotomy where like the Fed wants it to be a certain way where you deposit your money in a bank, but at the same time they want the bank to make risk-taking activities. So normally that's like loans, like if they're loaning out to businesses or something, it's like good risk-taking activities. And those risk-taking activities are supposed to be backed by the Fed in case they make bad decisions and that bank fails. Like the money in the bank should be protected in some respect. But at the same time, we're getting to the point where these banks are just so big and so large that like their loan activity is not the only thing that they have anymore. They're now getting into the business of making speculative bets on treasuries, right? And one thing that the Fed doesn't want people to do is sell treasuries. And so they've allowed for this like strange accounting with the hold to maturity accounting. They just don't want people to sell treasuries at all. So this is why they've set up all of their Kid, you gotta come back. Kid's gonna come back in a second because his recording stopped. But anyways, there's a lot of political conversations going to come through. I'd expect there's probably going to be some bipartisan support for a lot of these bills.
Yeah, I mean, at the end of the day, we're all in this together.
Mm-hmm.
It'd be such a massive legislative win on both sides if something gets passed. And I think it's something else to talk. And like, it would be to have like guidance and stuff, and this could hopefully end Operation Choke Point 2.0, which is, I think something. This is something like a big hanging cloud in all of this. Like,
Dave, let me ask you a question. Should the FRAX DAO fund some sort of PAC? Sort of like, should we start funding lobbying groups?
FRAX donated to Coin Center, right? They donated $60K to Coin Center. I think the real question is like, should a stablecoin only lobbying group get started? Like that, lobbies for the interest of payment stablecoins and stablecoins in general, because it's very different interest than cryptocurrencies, I think. I think you can make more of the argument of utility there, and they just have different objectives, like between stablecoins and other like tokens and whatnot. So I am in the camp that there should be a stablecoin lobbying group. I think the only one that's really taken the torch on that is Circle, because they're the only one that major payment stablecoin that exists in the US, and so that's why there hasn't been a major stablecoin like lobbying presence. But I feel like I think if there's a stablecoin only like lobbying group, like the FRAX DAO should vote to fund it.
Dave, can I ask you one more question?
What?
When are you getting out of LA in your like hipster clothing and putting on a suit and tie and going back to DC to save us all?
And shaving that stash.
Shaving that stash.
I don't know. I still have much to do on chain. I'll keep writing and advocating where I can on here, but I'd like to see crypto and stablecoins stay in the US, and it would be a real shame if we drop the ball here. And as I'm echoing Sam's sentiment here as being an American optimist. We haven't fucked up before, like with the railroad, with the internet, with the telephone. Like innovation happens in America for a reason, and it's soon will be crypto's turn. It's just up to. I think one thing we can do better is highlighting utility, but also, how can we get more adoption? Just like simple adoption. And I think that starts first and foremost with stablecoins. Like we can figure out a way with stablecoins to bring more adoption to crypto, whether it's like more efficient rails, cheaper rails, and hopefully I imagine with L2s and L3s coming online and things being cheaper, that will help lead to more adoption.
So speaking of Sam K, there was actually 2 interviews that got published this week. One was ours, of your interview with Sam K from ETH Denver. And then he also went on the Edge podcast for one that was titled Positive Sum World of Frax Finance. Do you guys get to listen to that one?
I mean, I did the
No, not the ETH Denver one, but the other one, the Edge.
I didn't get to listen to that one.
No, I haven't gotten to listen to it either. It's on my list. It's just this week's been a little bit crazy.
Yeah.
Notable things from this week. If you missed Frax Check, FrxETH hit its highest day ever in rewards. This past Friday.
The craziness of the weekend.
Yeah.
80 ETH.
80 ETH was a new high. The last high had been 21, which had been back in the middle of February. And so, this volatility is not a bad thing all the time. So even though we depegged, FrxETH had its time to shine.
Yeah. That's the cool thing about Frax is, it's diverse and spread out. And like in terms of policy changes, like one thing that's going to happen is more FrxETH on the balance sheet, which I'm sure is something like all of us are looking forward to.
Yeah. And speaking about FrxETH on the balance sheet, the governance proposal for increasing the AMO passed. That's been increased to $30 million now. But there are some questions about Fraxland in general. Westwood, a notable Telegram member, brought up the fact of why is there no AMO for the CRV pair, right? So there's almost $20 million of Frax in there, but there's no AMO for it. So his question was like, why are we not trying to fund it and engage in some sort of like interest rate war against like Aave and other things? So what do you guys think about that? Should we be creating new AMOs for these more volatile products?
That is a good question. I don't know. I have an answer or strong opinion on that, to be honest. And I don't want to I could see yes, if like our priority is yes, let's have the lowest interest rates. Let's compete with to have the lowest, let's compete with Aave Compound and have the lowest, and then yes, let's do the AMO. But if we want to be more risk averse, I guess, in terms of, then I don't know.
So here's a question. Instead of having a supply limit to the Fraxland AMOs, do you think it'd be better to have an interest rate targeting where we create a band where as long as it's in the band, we don't do anything. But as soon as the interest rate goes above, so let's say it's like a 3.5% or something. As soon as it goes above, we start minting more FRAX to put into the pool to bring it back down. Or if it goes below, we start pulling more FRAX out of that pool to bring back up. And we essentially have interest rate targeting rather than like a like an artificial supply cap. That way the AMOs can, or the FRAXland AMOs
How
can
do you
expand.
ensure safety on that?
What do you mean safety?
Like, what are the risks associated with, like automating interest rate management like that?
Well, I think the good thing about FRAXland is that the interest rates don't change immediately, right? So if the utilization goes from like 0 to 99 in one block, it's going to take some time before those interest rates actually rise to a point where they become much higher, right? It's going to take several hours for them to adjust, and so I don't really see a risk other than like us selecting which assets should have access to this interest.
I think
rate
it's
targeting.
a cool idea to
Yeah.
try out. Maybe try it out for the safer pairs at first, like interest rate targeting.
Yeah.
It's funny, like after the reserve interview this week, which is one of my favorite interviews. I just keep thinking this idea of FRAX is, we always talk about the central bank of crypto.
Mm-hmm.
And I could see these commercial banks being, built with reserve stablecoin infrastructure. Like you can just whip up your own stablecoins backed by FRAX collateral. And that stablecoin's focus could be on the more mass adoption and utility. Well, FRAX, their primary business is liquidity, and it's the liquidity machine, and they're in the liquidity business. I just think of like No Country for Old Men, like, I'm an oil man. It's like, Sam, I'm a liquidity man. It's not, so I could definitely see more stablecoins that are more adoption focused, like using FRAX as collateral. I don't know what your guys' thoughts on that.
Kid, do you have any thoughts on it?
Yeah, I feel maybe I still have some PTSD or lingering effects from what happened last week, but I figured now is just the time for us to,
let it out. We're here.
Chill pill, and just rethink our internal policy mechanism first before we start going out and backing, this stable coin or that other stable coin. And let's focus on our treasury, right? Like, I just feel, for example, we were, granted, USDC is not a bad asset to bag hold, but going back to how our AMO was basically drained of all the USDT, and we were left with DAI USDC that are 88 cents. Granted, that is a anomaly and a tail risk, but if anything, this year we've experienced 4 tail risks, and like, it's not even a year yet. It's only been 10 months. So I was just talking with a buddy of mine. It's like, we have 2 more months. Let's make it a $5 and let's give us another one so we can just cap the year off. Because every 4 to 6 months, we get hit with something. And I feel like, if it's great that FRAX survived, but I think FRAX survived because of,
the conservative nature of the DAO.
Yeah. And I guess like something we can talk about is, if that situation happens again, like, could we like, I think Kiet, you talked about this, like, how can we replace...
Dave, it's hard to hear you. Can you come a little bit closer?
How can we if this situation like were to happen again, like how could we mitigate it? Like how could we replace, take out, 3 or CRV and make more of our collateral backing Tether as a backup? For example, on like a much, much smaller scale, EUSD from Reserve, their backup reserve was Tether, and their system worked pretty well. It wasn't perfect. They still had like a 3% loss, but
that's a lot. Yeah, but that's great. That's fine when you're $1 million in size, but when you're $1 billion in size, it's like that's $30 million.
That's why I think we start even further back, right, Sam? We start from first principles and be like, is that even the right collateral set to be in?
It is. No, USDC is the right collateral set. It's the best. It's the second best thing until we get the FMA or the Stable Act comes along and USDC is able to get banking services, right? So there's just nothing better that we can swap into, right? Tether is this unknown opaque box that has like way more tail risk than USDC does, just on like other stuff. And
Tether just survives, dude. Tether's like a cockroach.
So like,
I mean, Slindy, like the longer something,
it's not. It's way more risky than USDC. you just don't see the risks, and people blind themselves to what the potential risks of USDT could be, and that's not something I think that we should. The whole point of FRAX is like maximum transparency, and basing your entire existence off of this like opaque asset is just not something that I see.
I mean, you're damned if you do, damned if you don't, and basically we're in this kind of purgatory waiting for the opportunity to get an FMA. And I have to agree with Sam's sentiments here, because people are like, oh, this FMA shit is impossible. Like, why are we even trying for it? This and that. It's like, we better like start laying the groundwork now. I guess like a comparison I can make to like a growing legal industry that like was once in the shadows is weed. like straight like the weed, like people they built like in the infrastructure now, and then when it became legal, it was the people that had the infrastructure ready to supply that took reap the rewards.
Just to go back, Sam K made a comment today saying, I think I've said this clearly as well. There is a high possibility that legislative clarity can come from Congress this year or early 2024. There are actual draft bills that propose FMA access to stablecoin issuers. Even Jeremy Allaire, the CEO of Circle, alluded to that in his tweet. So you can be sure, and top stablecoin issuers and banks are eyeing the same end goal. We must be ready to go with our infrastructure and protocol readiness to make sure we can utilize such an opportunity if it presents itself. Obviously, we know that the current TradFi climate is extremely hostile to crypto, and will probably get worse before it gets better. That doesn't mean that we should wait and see or listen to people saying FMA access is unrealistic or too lofty. We can't put any of our big plans on hold. On the contrary, this is the time to execute and build and create the opportunities that we want to see in the near future.
Facts.
Yeah. All right. So we'll end it there with comments from Sam, and we'll move on to a couple of other things. So old Paul, who is from Mazix, is hosting actually that's tonight. We're filming this on Thursday. It's going to be tonight. So if you're in Milan, there's going to be a FRAX meetup, or there was a FRAX meetup. Paul, if you want to send us some photos, we'll share.
FRAX meetup, let's go.
In this week in FRAX, I'll reach out to you as well too. Moving on to governance. Well, two things. So Metronome launched their Metronome launched their synthetic ETH product, and so that's live now. You can get up to, I believe it's 50% APY based on the current APRs inside of Metronome right now, which is like a 5x leverage on your stake FrxETH. So all you DGens out there, great new product to go out and try out. Yeah. In addition to that, I'm gonna share some governance screens. Let me pull this up. Okay. So let's just go through some of the proposals. Over the last week, there have been a couple of proposals that have passed. So obviously the stake FrxETH AMO passed, and also the FRAX ferries, but we talked about those last times. Right now, there's currently active votes for whitelisting convicts and staked out contracts for FPI. And we also talked about these last week. So this would give access to the VFPIS contracts, similar to how it's been set up with FXS for both convex and staked DAO. These were written by Hubert and C2TP from Convex. So these are up. There is another 2 days of voting, but it looks like they will pass. They already have quorum, and it looks like they're going to go through. So on the forum, there have been 3 new proposals that we're going to cover about. So we'll start with we'll start with the Metronome proposal. So this is actually an updated proposal from Metronome. We've covered it before. So this would, oops, let me make this go away. Metronome is essentially asking for CVX voting weight in return for, actually, I don't think they give anything here. Usually there's been something that they give. Probably it's because they're looking to boost the stake FrxETH.
A little boost.
Yeah, APYs, which are bringing a lot of liquidity into their pool. to generate that leverage that we just
the
talked
liquidity
about.
business.
Yeah. So this is probably pretty good. If you're a stake FrxETH holder, this is going to be pretty awesome for you. So if you want to boost your yields for stake FrxETH for 4 voting cycles, so that would be 8 weeks of 110,000 CVX, this is the place to go. And this one is not up for snapshot yet, but going to be pretty cool. It's going to be pretty degenerate, and it's probably going to create a whole new flywheel for stake FrxETH and FrxETH. Very cool to see. Huobi actually came, and I don't know if this is actually like.
I was thinking this could easily be. I just laughed at this. I don't even like.
Yeah, I don't know if this is actually a real one. We'll see if it actually comes out. But you would think that Huobi would like come through different channels or have like a longer proposal, right? Or somewhere where we could validate that it's actually like Huobi Global, right? And then the last one from this week was from developing liquidity positions in Kava. So it's from Equilibrium, a Velodrome fork recently launched in Kava EVM. Kava is a different network, and they are asking for liquidity, but there's no information. Maybe this one is a scam too, because they want to create a group chat. Okay, guys.
It's a quiet week. Let's end it there.
Yeah, light week. Okay. Light week, guys. So yeah, that's going to wrap it up. There'll be a bunch more screenshots and other things inside the This Week in Frax newsletter that goes out tomorrow. We'll be covering the events continuously as we go forward. And it feels like we're coming to a new shift where like now we have product market fit. Now we have to go fight for survival. And that's going to be the fun part over the next year.
We've been fighting since last year, to be honest, fighting and building.
Exactly.
Not much has changed.
Exactly. But it feels like with the introduction of the FPIS, we finally hit some sort of like ossification in the protocols where we have clear governance across each. And now we can specifically say like these are the 4 things that Frax does, which is like FPI, Frax, stake FrxETH, and soon to be actually no, we're missing one. Frax BTC, which is going to be coming soon.
Soon
TM.
Yeah. Sam, you want to close this out?
Oh yeah. Thank you everybody for tuning in to yet another This Week in Frax. I am Sam McCullough, your host, and I'm joined again by DeFi Dave and Capital K. Guys, where can people find you?
You can find me on Twitter at DeFi Dave 22 and also Instagram, Dave Doing Things. Alpha.
You can find me on Twitter at 0xcapital_K, and you can find me on Telegram at Dave Doing Things. Go ahead and DM that.
That's yet another impersonator. Be careful. You want to hear some really funny story? One time, my friends added the wrong DeFi Dave to a Telegram group chat, and they were just like talk. And my friends were like, "Why'd you leave the group chat?" I'm like, "You never added me." And then they realized I told them like, "You added the scam Dave." They're like, "Oh."
The scam
so
Dave.
then I bought Telegram Premium, so I wouldn't have that again.
The faux Dave. Got it.
Oh man.
Will the real DeFi Dave please stand up?
Yes.
Sam, where can they find you?
You can find me on Twitter at traders_insight.
And if you want to find us on Twitter at Flywheel DeFi, Telegram at Flywheel DeFi, make sure you subscribe, hit that bell button for all the latest alpha updates, Frax, DeFi, and everything in between. And make sure you subscribe to our newsletter, flywheelupper.com, all the alpha. Sam just pumping out content like it's no tomorrow. So thanks everyone for joining us, and we'll see you next week.
Peace.